GM, good morning. Welcome to the Milk Road Show, the daily crypto show that levels the playing field. No inheritance, no hedge fund, no problem. I'm your host, Jay Hamilton. It's Saturday, March 29th, which means we are back with the Milk Road Pro research team. That's right. We got Kyle, Martin, and Adrian in the house. These guys, all they do is research and think about crypto all day, every day. In today's conversation, we're going to break down crypto leverage. Have you ever thought about doing leverage? Are you doing leverage, or do you want to learn how to do leverage? Martin breaks down his plan, or I should say, he breaks down exactly how he's doing leverage right now. Super interesting conversation. Also, Coinbase drops a massive update. We're going to talk about that. We're going to talk about stablecoins and so much more. Now, this episode was available to pro members on Tuesday. We released it to you guys for free on Saturday. If you want to get this alpha on Tuesday, you can go pro today. Also, if you go pro, and one reason why you might want to go pro right now, to be honest, is we just dropped today a report on data availability and the opportunity we see to invest in some specific tokens in that space. It's a massive opportunity. Data availability is really the next layer of blockchain that we think could have asymmetric returns. So you might want to go pro to get that report. Honestly, you can hit the link in the show notes. You can read the first part of the pro for free and then decide if you want to read the rest. No pressure, of course. Today's episode is brought to you by Definitive Advanced Trading of Every Chain. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin CSUSDL. Without further ado, let's hear from the boys.
All right. Welcome, everyone, back to another episode, another pro research meeting. We're here with the boys, and we're going to talk shop. I almost said chat and talk at the same time, and that didn't make any sense. All right. Well, we're going to talk a little bit of, actually, we're going to start the conversation about a question I wanted to talk to Martin about, because I noticed on his Twitter, his cover photo. I'll actually just share it. It's a terrible looking cover photo, by the way. So Martin, we need to fix this. We need someone to redesign it. But this says, understand the technology, contribute to Web3, maximize dollar debt. And I was like, the other day, I was like, Martin, do you take leverage? Like, do you take out debt to acquire more crypto? And he said, yes. And so I want to understand how he does that, because I know he's also very risk adverse. So we're going to chat there, because obviously we always say no leverage. And then we're going to talk about something that Coinbase launched last week, which was verified liquidity pools. We think this is a pretty big deal. We're going to just chat about that, what that means for Aerodrome. And we're also going to introduce something new that we're doing for Pro called Token Snapshots. So make sure you check that out. And then we're going to talk stablecoins. Probably the coolest thing right now in crypto, although crypto natives don't believe that, but I definitely do. A lot of growth happening there, and we're excited. So we'll chat about that. Okay, let's first start on this topic of leverage. Martin, who is our resident non-degen, right? He's like the risk adverse person who's just like, wants to make sure he's always taking care of his portfolio. Turns out he's levered up to the tip. No, I'm kidding. But he does have a little bit of leverage. And I want to understand how he does it, why he does it. So Martin, I'm just going to throw it to you. You told me that you use dollar debt to acquire crypto. Tell me how you do this and why.
Maybe I'll start with why. And the reason is quite simple. I think there is a trend of crypto, and crypto is now 3 trillion, but we think that we are heading to 10 trillion, then maybe, 30, and then 50, whatever. But the trend is quite obvious. I just don't know when we are going to hit 10 trillion. Is it going to be in 6 months or 8 months? I don't know, but I think it's going to happen eventually. And if I can borrow and pay, let's say 6-8%, some external money, which I wouldn't otherwise have, and buy more crypto, then I'm going to do it. And I don't mind paying like 6-8% per year for having that leverage, because I know that at some point I will be selling the tokens and I will be like hugely rewarded for doing so. Now, I want to say I don't recommend anyone to take leverage, because it's very risky. And I guess if it's your first or second cycle, I wouldn't still recommend taking leverage. And especially because people are not good in managing risks, and in general, like this is not a good idea for most people, I would
When you
say.
say you're taking out leverage, is this you're putting your ETH or your Bitcoin, for example, into something to get dollars back, or you're taking out a loan at the bank where there's no like collateral? You're just like you got a line of credit that you pay 6% on, and you're using that to buy crypto. Which type of leverage are we talking here?
On the blockchains.
On the blockchains. Okay, so you're using
I,
DeFi to take out leverage.
yes. And outside of
But
that, like in traditional world, I use mortgage like everyone else here, which is pretty much the same thing. I will just,
yeah,
this is my contract. I'm getting some money, so give me like, much more, and I will buy a house or whatever. It's kind of similar thing, but here
and
you
so
need to put the collateral in.
right. So the bet you're making is I think that I can outperform 6 to 8% in a year. And so if I just take that out, grab however much in dollars and then buy crypto with that, I'm going to outperform 6 to 8%. Then I can take the profits of that and
Yeah.
and pay back my loan.
Yes.
Is it a trade for one cycle, Martin, for this bull run or longer?
Yeah, like at some point I'm gonna probably sell and get rid of all the leverage I have. But on a like then I will probably start to do another leverage like for the next cycle. So I would say like maybe it's cycles driven, because it doesn't make too much sense. Like, we were talking about the price predictions of, I don't know, Bitcoin hitting 200K, ETH 10K, whatever. So like if we are getting close to these prices, like I want to be already out of this trade, and like I don't want to have any leverage at that point. And
Yeah, this
then
is
probably, I don't know, after 2-3 years, I'm gonna probably start doing the same trade again.
this is the key. So if I had to guess, you probably took out this loan originally in what, 2023, 2024? When did you first take out the loan?
Yeah, like I took some loan, like I also DCA these loans kind of thing. So it's not like one time thing. Um, I'm just trying to um, make sure that my loan to value ratio is somehow safe, and it makes me feel, safe also, so I
What
can
what is
sleep
that?
well. And
What is your loan to value ratio?
like right now it's 25%, maybe 30%, but
Okay.
like I I don't think we are going much lower. And if even if we are, I'm still like I would still handle quite well if there is another 50% drop.
Right. So like you wouldn't get liquidated unless ETH, I don't know what you're using, ETH or Bitcoin or whatever, but unless it went down another what, 50, 75% from here,
Yeah,
like
would
we'd
need
have
to
to
go
go
down
into
like over 75%.
right. So like ETH would have to be at like $500,
Yeah.
$750, something like that. Okay. So couple things to understand here for those listening. He's maximizing his dollar debt because it's pretty cheap to get a loan. And he feels, and he's also using this to buy majors that he thinks will go up over time. But there's two really, really important things to understand here. We always say don't use leverage, and I still believe that. So just everyone listening here, don't think that this is the ticket to go and do it. Because there's two really important things that Martin said. You take out leverage in bear markets or at the beginning of a bull market, first of all, right? Because then your risk, there's not a lot of downside risk if you bought and did this in early 2023, right? When we FTX collapses, you have all the bad news you can possibly have. And it's kind of sitting there and you're like, there's no way this stuff can go any lower. That's when you take out leverage. Now, here's the flip side. Most people do the opposite. They take out leverage at the end of the cycle, at the top of the cycle, because that's when they're most bullish and euphoric and excited. Everyone I know did that last cycle. And that's why all my friends got blown up. Every single one of them. They all took out leverage using Celsius, FTX, BlockFi, etc. And they got blown up on their LTV or their ratios. And then they had to put more money in to make sure that they didn't get blown up. And then the things collapsed. And so they got double screwed. Okay. So like, first of all, if you're going to do this, probably don't do it on centralized lenders. But more importantly, you take out the loan early. Just like what we always say is like, at the bottom of the business cycle, that's when you allocate. That's when you start to add in more risk. That's when you would do this if you were ever to do it. And then the other key thing here is this is not a 10x leverage or 100x leverage or whatever. This is a very, very small leverage to get a little bit extra. And he can stomach 80, 90% vol here, and he still doesn't get liquidated. And so it's a very, very, very low risk. And the other thing I would say, I would also imagine if I was asked Martin, let's say Martin has, I have no idea how much ETH he has, but let's say he has 100 ETH just for like a round number. I would imagine you didn't put 100 ETH into this loan. You probably put 10 or 20 or 30 so that if ever it was needed, you could refill back up and protect that collateral. Am I right or am I wrong in that? Or is it all of it?
I wouldn't say 20%. I would say more like 70, 80%. And then the rest is
Wow.
like if I want to use something else.
Interesting.
But yeah.
Okay.
Did you recently increase the leverage in the current drawdown and basically borrow more and buy more of your asset to lend it then?
A little bit, yes.
Interesting.
But it wasn't any significant. Like I have most of the stack for a long time. So yeah, no big changes.
By the way, there was a world where I remember this really coming out last cycle where you actually never really need to sell your assets. You can just continue to accumulate Bitcoin or ETH. Again, these have to be assets that long-term go up over time. And if they do continue to go up, then you can continuously just increase your loans against them and use that to pay for things in the real world, right? And as long as it keeps appreciating, then you actually don't have to pay it back. Essentially, there's ways to get around it with DeFi, and so there's a world where you never have to use cash, like your income, to buy things. You can continuously just dollar cost average it to Bitcoin, which increases the amount, and then you just keep taking out dollars to pay for your expenses. And as long as the underlying asset continues to depreciate, then it works out. Again, not an easy thing to do, not something I recommend anyone do, but there is a world where that does make sense, especially with something like Bitcoin that has gone up historically 100 and whatever percent year over year. But very interesting. I did not know that you did that, Martin, and I appreciate you sharing that with our listeners. I would be interested for those listening, how many of you guys do the same? I know in our pro Discord, as much as we say don't do leverage, there's a lot of our pro members actually do use leverage. Now, there's a difference in this kind of leverage, which is kind of like just a long-term small loan versus like 10x trading, right? Trying to swing trade on like pumps and dumps and stuff like that. Like it is a very different thing. But curious, just in general, who else is doing that? So please comment below. Just let us know. We want to know what our audience does. Anything else on this side of things before we move to the next topic?
Maybe on which
Who's got?
blockchain do
Hang
you
on,
do
pause
this?
for a second. Who's got music in the background?
Okay, it's me, I guess. Sorry.
If it's not a truck driving by or kids screaming, he's got fucking elevator music on. It's how he stays calm during tough markets when he's over leveraged. All right. Anything else on this side of things? Cool. Okay.
Yeah, on which blockchain do you already do this, Martin? Do you do it on
Ethereum
ETH
mainnet.
or on Base?
Ethereum mainnet, and then I have also some leverage on Sol. I still feel like.
Did you turn the music back on?
The music is still on.
Yeah.
What the heck is going on?
There's a DJ in his house.
I still feel that the big money and the big players and pretty much everyone managing like a decent portfolio, they are still using mainnet. Like Base and Arbitrum, Optimism, everything is cool and nice, but those are still multisigs. And I feel very safe using Ethereum and nothing else.
Which protocol? So, where do you get your loans? Is it Morpho or Spark?
Spark or summer.fi, which is kind of front end for Spark, I would say, which will let you automate some things.
Very interesting.
If you're only trading on centralized exchanges, then you're not going to make it. The best traders know the alpha is on-chain. Definitive, founded by Coinbase alums, lets you trade any token on Solana, Base, or any chain all in one platform. What makes Definitive different is its advanced order types. You can execute limit, TWAP, and stop loss completely on-chain. Plus, you get the best prices as your order is routed instantly through every DEX and liquidity pool, getting you up to 19 times lower fees. Trusted by funds, whales, and the milkman himself, now you too can trade like a pro. Milk Road listeners get a tasty glass of milk with 0 fees on your first 25,000 at milkroad.definitive.fi. Meet CSUSDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security. Backed by regulated real world assets and secured with institutional grade risk management by our friends at Stakehouse Financial, put your treasury cash to work, earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over 1 billion in business treasuries on chain, including Aave, Gitcoin, and hundreds of leading institutions. CYCS USDL is gaining traction at milkroad.com/Coinshift.
Cool. Okay, guys. Well, we're gonna wrap that up there. Let's move on to something that Coinbase launched recently, which we think is quite interesting. I'll give a quick summary of what this is, and then we'll leave it up for discussion on if this is a good thing, bad thing, or like what this means. So Coinbase introduced last week Coinbase verified pools, which this is essentially a way to trade in a more, let's call it trusted way, but using KYC. So essentially you have liquidity pools on Uniswap, right? Or on any DEX, and anyone can interact with those permissionlessly. What Coinbase has created is verified pools, meaning you have to be verified or KYC'd to interact with those pools, to provide liquidity and to trade with them. And so what Coinbase can do is, just as an example, institutions, they have certain requirements, different institutions, on which types of capital around the world that they are allowed to participate in. So like sanctioned, investments in financial assets, they're not allowed to touch, right? Investments or assets that were, held or created by terrorists and things like that, like they are not allowed to touch that stuff. They have to stay away from that stuff. And that's really hard to do on chain because everything's permissionless and global, and there's no way to stop that. And so what Coinbase has done is using Uniswap and their, what is it called? Not frames, but hooks.
Hooks.
Yeah, hooks. They have created basically an integration into Uniswap where they can have these kind of verified liquidity pools. And Coinbase has verification through the Coinbase app, through Coinbase Prime, which is their institutional thing. And through their, they have like on-chain verified credentials. And so they have a bunch of different ways to actually bring KYC on chain. Instead of forcing them to use it in the app itself, they can actually move on chain, and they can, by putting kind of like a verification credential in the wallet, they can see if that wallet is actually a verified person that is not a criminal, et cetera. And so pretty cool. They built this on Base using Uniswap and Uniswap v4 protocol. And I think this is a step in the right direction for tokenized stocks, something we've talked about a bunch. If they want to bring stocks on chain, right? One of the big things is stocks, you need to, well, there's certain things. So like private stocks or private shares need to be accredited investors. And so we need KYC to know, are they accredited investor or not? And then actual stocks, like in the US, for example, they can only have certain US people or other people around the world, but certain people can actually buy the stuff and hold on to it. And it's illegal to have others. And so this is their way to kind of like enable that while still keeping it permissionlessly and keeping it, or not permissionlessly, but keeping it still self-custodial, right? So it's not, I don't have to trust Coinbase to hold it. I can still hold it, but only certain people can actually touch it. So crypto OGs with the ethos probably don't like it. Others probably in the TradFi world, they do like it. We'll leave it up to discussion here. Is this a good thing? Is this a bad thing? Like what's going on here? Martin, I know you have some thoughts, so I'll throw it to you first.
I think there is something more that Coinbase decided to use these verified pools outside of just, hey, this is good for institutions, then they can provide KYC and it's only accessible to kind of verified users. Because you could only leave it on your centralized exchange and just use centralized order books and just let people to trade, and your market makers would manage all the liquidity and everything. So like what's the right purpose here to moving that liquidity from your centralized exchange to the outside world on the blockchain? It starts to feel like they see obviously more potential on the blockchains versus if it's just isolated on their centralized servers. So that's kind of one thing, but it's still just verified. So you still need to be like just Coinbase user or somehow KYC'd by Coinbase to kind of use that liquidity or provide that liquidity there. So yes, tokenized stocks could be a good example here. But outside of the tokenized stocks, like if I want to trade just, I don't know, let's say ETH and USDC, why they shouldn't just introduce and use, I don't know, Aerodrome or Cowswap or, whoever else who will always provide like very good trades with like very reduced slippage anyways. So there needs to be something. And to me, it starts to feel like, okay, we need to pay all these market makers anyway to provide liquidity on our exchange. And it's very costly and expensive for us to make sure that we cover all the tokens, because we have seen a lot of new meme coins that were not available on Coinbase, or not just meme coins, like even cow protocol. We like cow, and they were cow token were listed on Coinbase just a couple months ago. So it feels like it's very costly for them to kind of incentivize the market makers and be able to offer enough liquidity for everything that people wants to trade. And now it's starting to feel like, now let's try to move our centralized books to the blockchains, but still just have, kind of control who can access them and who can provide that liquidity. But eventually, maybe we will open it for everyone, because at that point we will already have enough liquidity and a lot of users, and a lot of aggregators will be using our liquidity pools. So then you get that advantage, and then you can eventually kind of open those pools to everyone, and it will just attract more liquidity to.
Don't you think that they're doing the verified because of regulation, and you need this in the traditional world to bring accredited investors and institutions in? So I think they'll always have two liquidity pools. They'll have one that's open and permissionless for anyone to trade, and you'll probably get better rates and things there. And then you'll have one that is for verified users only, and that is for probably institutions and those that have like rules and regulations, like banks and things like that. That's the way I see it.
Yeah, I'm not sure if that will remain the thing, that like if I am, I don't know, bank, I cannot trade on just permissionless blockchains. I think this is shifting, and now
Right.
we
Maybe
are
that
also,
changes regulation around
yeah,
that.
yeah, I
I
think
can see
so.
that.
And also, like, if you listen BlackRock or some people from Bank of America, they are saying like, yeah, we might thought first that we are gonna use private blockchains, but now we are gonna use like public blockchains.
Yeah.
So it's also kind of feeling that that's the direction.
When you say
Right.
this is Coinbase moving their, I'll throw it over to you in a second, Adrian, but I just want to comment on one thing. You said this is Coinbase moving their centralized order books over onto decentralized infrastructure. The reason they do this, by the way, is because the margins are way better when you move it on chain than when you do it in a centralized fashion. Robinhood, for example, the founder of Robinhood, Vlad, he was on an interview and he said, on-chain assets are 10x more profitable or have 10x better margins than off-chain products. So he's like, all we want is more things that are on-chain, which is why not only are they bringing a bunch of crypto assets into Robinhood, they're also trying to bring stocks on-chain rather than off-chain, because there's way less middlemen. Like, I don't think people realize how many middlemen are involved to trade a stock. It's like, it's next level. You wouldn't even imagine. You don't even want to go down that rabbit hole because it's disgusting. There's so many fees and all these different people. And it's like this little piece of paper of ownership of a stock just gets passed around from person to person or entity to entity all around the world. And it's just like, what is this thing? And everyone's just like, I'll take a little bit of a cut, a little bit of a cut, a little bit of a cut. And so when you can remove all those people and all of that, those fees, it's the margins are way better. And it can settle and move much faster, which is fantastic, right? Right now, I'm trying to like move some. I own, so there's this thing called the Norbert Gambit. I don't know if anyone knows what that is, but basically, if there are stocks in Canada, for example, that are traded in CAD, the Canadian dollar, and then there's the same stock in the US that's traded in the US dollar. And if I can do what's called a journal share or Norbert Gambit, where I can just ask my broker to move that stock from the Canadian one to the US one, and I don't pay any conversion fees. It just auto transfers the shares over. And instead of me having to sell that and then convert my Canadian into US to then buy the US stock, which would cost me about 1.5%. So imagine you're moving 100 grand, 1.5%. That is a shit. That's $1,500 just to move over. It's crazy. It's free to do it this way. And so DEXs make that, it's going to take 4 days for them to do this. 4 freaking days. It's like 4 days. I got to wait for you guys to move this thing over. That's insane. And of course, when things move on chain, it settles immediately. It would take me 2 seconds and I wouldn't have to ask them to do it. So the reasons that they're trying to move things on chain are so obvious, and it makes sense for both user and the business themselves. Adrian, I'll toss it to you. I know you had a comment you wanted to say.
Yeah, completely agree with the on-chain thesis, and it's more efficient. Basically, there are more fees to be generated, but verified pools might still be just an experiment because we don't know whether there's really a target group. If I remember correctly, Aave had Aave Arc, an institutional lending platform, basically, and they stopped it because there was just no demand from institutions.
How
and
long ago was that?
Most liquidity will be in the general DeFi pools. So why should they use verified pools when fees are higher, when there's less liquidity? So we will see.
I don't know that there's going to be less liquidity. Like, we got to remember here, the numbers that we look at today are nothing, right? TradFi has trillions of dollars. Retail is what makes up all the liquidity pools today. Our numbers are peanuts compared to the TradFi world, where there's literally trillions, if not more than trillions, when you get into derivatives. When TradFi comes and actually uses DeFi and creates their own liquidity pools, they're going to just eat the retail liquidity pools. So I think they're going to be way, way, way bigger. And until what Martin said, of potentially regulation changes where they can just participate in open permissionless liquidity pools. If they can't do that, like if that doesn't change, I think that verified liquidity pools will get much bigger. But
we could have a cold start problem there, because if there's no liquidity from the beginning, then nobody will use it.
Yep, could. But I think Coinbase already has that liquidity off chain, and it's not difficult for them to just move that on chain, right? For the trader, for the average person, right? They don't necessarily know or realize where they're doing it. But for Coinbase underneath, this is better for their operating business, right? So they might just, again, kind of like what they did with Morpho, where they just integrate it into it and you still do it on the app. They could just do that, right? Like, there's a really good chance that Coinbase app, all the trades that happen on Coinbase app just run through these verified pools instead. And so instead of them trading off chain, they're just doing it through this. And that's just way better for their business, which hopefully they can pass those better fees on to the users. Will they do that? I don't know. Banks don't do that, but maybe crypto companies will. I don't know. We'll see. Anyone else have thoughts here?
One more thing here I want to mention is we have seen Coinbase using Morpho and now using Uniswap. And what it tells us is they are using their code, kind of smart contracts, but they are not necessarily using their products, which are, like Coinbase provide access to Morpho vaults, but they will just, hey, Morpho, here is your code. Thank you. We are going to use your code. But they are not necessarily using the products that Morpho brings like to the market. So if you the point I want to make is it going to be the future where the Coinbase and other fintechs, they will just use the code that are written by existing DeFi apps, or are they really going to use the products that are available on DeFi? So instead of just using the code, they will tap into the network effects that it brings with everything else. So because that's something we haven't seen yet, and I wonder if that's already kind of showing us the direction where we are headed.
So is there no fee being accrued back to Morpho for these loans?
No.
In that Coinbase integration? Interesting. And same with Uniswap, I guess, because they're just using the hook. Yeah, that is interesting. I don't know what that's going to look like, but that's a good point. Jay, you were going to say something?
Does verified pools bring more liquidity in the short term? The discussion of long term, whether institutions will use this or not, who knows? But that's long term, right? That's not even medium term. Like, those types of regulations take years and years and years to change. So short term, does this bring more liquidity on chain?
I think so. I mean, I don't think they would have launched this if they didn't already talk to the market makers and like try to figure out how to do this. Like, why would they waste their time? I think for sure. I think that there's capital that wants to come on chain, but is not allowed to come on chain, and this allows them to come on chain. So I know Aave did this previously. You're saying, Adrian, but like, I assume that was pre everything being ready to do it. Now it's pretty clear that regulation's about to change. We're going to get a market structure bill this year, stablecoin bill. So it's like we've kind of got the green light, although not fully yet until those bills are passed. But like it's a different world today than it was even just 6 months ago. And so I think the institutional products weren't really ready back then. And it didn't make sense because the demand wasn't there. I think the demand is definitely there now. And it's, Aave also just launched their new institution protocol as well. So like, I think they might have turned it off and now they're coming back. So I think it does bring liquidity. Now, how long does this take? I don't know. TradFi moves slow. So like, I don't expect this like to happen tomorrow, right? Like when Coinbase integrated with Morpho, it was like within the next week they had $100 million worth of USDC on their backed loans, and I don't know that this happens because again, this will take a while. They've got to get approval. They've got it's going to take a bit, but does it ultimately bring liquidity? I think so. I don't know.
Yeah, but I agree with your point, Jay, that in the short term, I don't see like banks and funds like
Yeah,
now
doing it. Yeah.
not be able to, I don't know, buy ETH or Bitcoin or whatever, and suddenly, hey, there are verified pools on Coinbase. Let's use them. So like, I agree. But maybe like retail, they are gonna use it because now, like they might not feel safe using like open permissionless protocols, but now there is a stamp. This is verified by Coinbase. So like I can see people using these pools and instead of just going out there and looking for DEX aggregators or whatever. So
I see it the complete opposite. I don't think retail gives a shit and even thinks about that at all. I don't even think they know what any of this is. I think they either just trade on Uniswap and they hope for the best, or they just trade on Coinbase app. The people who do know about this and do actually care is institutions, because many of them are just not allowed to trade on public blockchains right now.
I would have
this gives
agreed.
them
I would have agreed with you until a few days ago. We're working with MoonPay. They're a sponsor coming up on the show next month, and chatting with them, they and MoonPay's,
one of the
massive
biggest. Yeah.
crypto company, and they really pointed this out to me, and I almost didn't really believe them, was that they have one of their biggest portions of their customer base is exactly that. It is people who want to be on retail, who wants to be on chain, but they're very afraid of security and scams and risk, and they don't love DeFi. They want like centralized on chain, and they want verified on chain, which I was like, wow, really? But then look at MoonPay and look how big it is. So, I think you might be right, Martin. It's not us, and it's not a lot of the community that we see, the crypto natives, but they're out there.
Yeah, because we all live in a bubble. Like we think everyone knows CowSwap, everyone knows, I don't know, OneInch and these aggregators, but people don't. They don't like they want to do some trades or swap tokens, but they don't know where. So they will always use Coinbase or
Milk Road
Binance
Swap
or whatever.
I was gonna say,
Or
Martin,
Milk
why
Road
don't you ever
Swap,
see
yeah.
Milk Road Swap? The guy says cow
Yeah,
protocol.
that's right.
This small. What about
Yeah,
ours?
that's
What
right.
about
Yeah,
ours?
yeah.
Give it some respect. Put some respect
Yeah,
on
that's
its
right.
name. Milk Road Swap. Don't forget it. All right. The one thing that was brought up from this that I thought was the most interesting and had a lot of conversation on Twitter was Coinbase decided to use Uniswap. And one of the things that we've talked about is we said many times that Coinbase is going to integrate with a DEX. I've been saying this since their earnings call back in whenever that was. I thought it was going to be Aerodrome, because Aerodrome, similar to Morpho, is like native to Base. Pretty sure Coinbase Ventures invested in Aerodrome just like they did Morpho. So like it's that flywheel that they're building on Base where, let's fund these companies to build cool products. And then as they build them, we'll integrate into them. And that makes our business better, blah, blah, blah. And they didn't actually do it. Now, they did Uniswap because Aerodrome doesn't have hooks. So they don't have the ability to create verified pools yet. So that is what they said. The founder of Aerodrome actually said they came to us, I think he said about 8 months ago, Coinbase did, and talked about this. And they were just like, yeah, we don't want to work on that right now. We've got other things we got to build. They're obviously a much newer company protocol than Uniswap. So they actually, at least what the founder says on Twitter, is they turned down Coinbase to do this. And so that's why Coinbase
might
went
have
to
been a
Uniswap.
mistake.
I completely agree. It's like, what do you mean? You've got the biggest company in all of crypto except for Binance that wants to build on your protocol, and you said no because we want to work on whatever they're working on. I don't know that's a smart decision, but anyway, that's I guess what happened. So is this bearish or just doesn't really matter for Aerodrome? I guess we can start with that question. Then I want to introduce something, these token snapshots, something that we've created with Pro, but just quick thoughts on this.
I'll just say that Coinbase Ventures, that they invested in Aerodrome. Does it mean that they are really bullish on Aero, the token, and the team and whatever they built? Or is their goal just like, hey, just support whoever builds on base and we don't care. You don't need to bring any money. Just, here are some money and just allocate it in the ecosystem and kind of support the growth of base ecosystem. Because I would argue that probably the second thing is true. They're just trying to support the ecosystem growth, and they don't need to bring any money, any returns.
Agreed. However, if they did, like, let's say they own half of Aerodrome, and you integrate it into Coinbase, you've created this flywheel, right? Where like you have these users on Coinbase, you're moving them over to Base using this protocol that you own half of. It's exactly what they're doing with Circle. They own close to half of Circle or something like that. I don't know what the percent actually is, but it's estimates around there. So they push people to use USDC, not because like they do that because, well, they own half of it. And so any of the revenue that comes from USDC, they have upside from that, right? So like, why wouldn't you want to do that with the things that you invest in? Now, maybe they're investing in Uniswap. I don't know. They could also be invested in Uni token. They probably are, to be honest.
Maybe also because like if you provide liquidity on Aerodrome, you are getting money. They're pretty much printing new Aero tokens, and those are your incentives and rewards. So I can imagine if Coinbase is using them, then what about all these users? Are those kind of rewards that they will have to put taxes on, or like how would that work? So it's much more complicated rather than just, hey, this is Uniswap, you can just launch there and you will only earn trading fees. It's a different thing.
It's definitely a lot less risk to go with Uniswap versus Aerodrome because Aerodrome is still, I don't know, what are they, a year old, maybe something like that. And they're still new. They're still doing a lot of token incentives. They still got a lot of things to figure out over there. And so like for risk purposes, which we know Coinbase really cares about, kind of makes sense to go Uniswap. But that was one of my bullish potential cases for Aerodrome. With that, I guess it's not out the window. They can always go back to Aerodrome. It's not like this is set in stone, but I think that definitely changes my outlook on Aero, at least for the short term. Any more thoughts on this before we show the new token snapshot?
I think that many people see Aero token as a better play for base. So like everyone was bullish on base, but there is no base token. So what's the best kind of token I could buy and give me that exposure? And it's Aero. So now we see some rumors that probably coin is gonna be tokenized and available pretty soon on the blockchains, and maybe there is never going to be a base token itself, but there will be coin, the kind of token representing everything that's happening there, and so it might also take some of the kind of flows from Aero.
Here's a quick question for you guys, and this is a little bit off topic. Do you guys think that they will use coin as gas fees on base? Or for example, Robinhood launches an L2, tokenizes Hood, and Hood becomes the like currency or the gas fee of their L2. I don't love that at all. I think it makes no sense, but I've just seen people talking about it. You guys bullish on that idea? Not bullish on that idea?
Like, why would they do it?
No, utility for their token, right? A reason for people to buy their token or their stock.
Wait, is it a separate coin token? It's not a tokenized Coinbase stock.
No, tokenized Coinbase stock is what I mean.
I think we will pay, like all blockchain fees will be eventually paid in stablecoins, because users are not going to pay those fees. Like apps are going to probably pay those fees for the users. And I don't want to have liability of some token that is super volatile. Instead, I want to have something stable and make sure that I can kind of predict my costs. So like, yeah, it just doesn't make sense to.
It's true. They probably just get subtracted away.
Yeah.
Yeah. Okay, cool. So check this out, guys. We want to show you something, and we will bring it up on the show every once in a while. We've launched something new called Token Snapshot. And this is essentially, we have our pro portfolio, which you guys know about. Those of you that are not pro members, you probably don't know about it, but go pro, you can see our entire portfolio, how we allocate exact amounts of what we allocate to different tokens and investments. But one of the things is we always get a ton of questions about a bunch of tokens that we don't necessarily hold in our portfolio, but we do look into, and they might eventually make it into our portfolio or they might not. And so one of the things we did recently was we launched the Token Center. That was maybe last month or something, where we kind of have a list of 20 or so tokens right now. And we sort of just give a bullish, bearish, or neutral rating on these tokens. You can see them all again at the Token Center as a pro member. But what we didn't put with that was much analysis around the tokens. So there wasn't really a lot of thought as to why we gave those ratings. And so what we've decided to do is we will only add tokens to the Token Center moving forward if we've done and created a sort of full, not full analysis, but a we call this like a snapshot analysis. So we look at the token or we look at the project today. We kind of analyze it. What is it? What's the bull case? What are the opportunities? What's the bear case? So what are the challenges? And then what to watch for? Basically, like, here's the things you should look for, the metrics you should look at, the things you might need to happen for it to be bullish or bearish or neutral. The first one I have up here is Aerodrome that we've launched this week. So basically, we just explain what it is. You can see the bull case for it, which is around the idea of Aerodrome currently is the number one DEX on Base in terms of trading volume, and it's pretty large volumes at this point. So that's one interesting thing. The idea of it being integrated in with Coinbase is obviously something that could be a big deal, but right now not so much. And then Aero was also included into Coinbase 50 index recently, which is quite cool. This is like a thing that right now is not huge for Coinbase, but we think will be if it makes it into kind of like an ETF, which is basically Coinbase saying, here's the top 50 tokens in the space. If you want exposure to crypto at large, you can invest in this one token called Coinbase 50, or this one stock, sorry. And right now, Aero was added to that, I think, last month. So that's a pretty bullish case. If this thing does explode, Aero would get a lot of passive flows as a result of that. And I do think, Jay's had Matt Hogan on the podcast who talked a lot about this. Like, indexes will be the future for crypto, and there aren't really any yet. And so those are coming. And if Coinbase can be one of the first ones, I think that's gonna be a really, really big deal. I would definitely put capital on this, and I think I would definitely recommend our audience do the same. On the bear side of things, though, everything's still kind of new, and Aerodrome is incentivizing a lot of their volumes. So they still have incentives, kind of like what a lot of DeFi projects used to do, where they just give away their tokens for people to trade or like do things on their protocol. And so a lot of this volume that's making Aerodrome the number one on Base that everyone's all excited about, which actually I have down on a chart here. They're currently, I don't know, a little over 50%. So beating Uniswap, which is like the only DEX to do this on basically any chain that Uniswap's on. But that's because it's being incentivized, we think, anyway. And so when those incentives turn off, it's very likely that those volumes, I don't know if go away, but probably go down a lot. So that's our big thing to watch for, is like what happens as those incentives go lower? Will the volume still continue? And what kind of happens with these integrations with Coinbase, et cetera? Uniswap is a beast, and it's going to be very hard to beat them. So that's just, we kind of have our list of what to watch for here. You can find this in the Token Center. So you just log into your Milk Road Pro account there. You'll see it there. We're going to have more of these. So Aero is our first one. This was all Adrian's work. So kudos to Adrian for setting this up. He's going to have a bunch of these for those that are in pro in the community. He's also going to run polls on like which ones we should cover in the future. So make sure to check that out. Anyone want to add anything else to the token snapshot?
This is incredible, Jen. This is amazing. I love this. I'm hyped. Wow.
And to be clear, this is not financial advice necessarily. This is more like giving you guys a detailed, fairly detailed like overview of we're going to try and cover a lot of the most popular tokens in the space. And so this just kind of helps you guys make decisions. We're not saying we are buying or not buying. We do put a bullish, neutral, or bearish rating on it. If you have to go sign up and check out our Token Center to see what our rating is on Aerodrome, I'm not going to tell you that here. But basically that's comparing it to the market, the overall crypto market, not necessarily to like the USD. So if we put bearish, the token could still go up. We just think that there's other competitors that might do better. Adrian, you were going to say something?
Yeah, it's interesting because competition is really fierce on Base now, with Uniswap having less volume, but actually generating a lot more fees, almost double the fees of Aerodrome. So we always hear about Aerodrome, the number one DEX on Base, but yeah, actually this might be changing. And Uniswap has a lot more active wallets trading, even though there's a lot of bots also using primarily Uniswap instead of Aerodrome. So interesting to watch this and see whether it could be a potential portfolio pick in the future.
Yeah, I think people often find charts on Twitter, like the fact that Aerodrome has more volume than anyone else in base, and they just go, okay, that's super bullish. We got to invest in that. And the reason for these one pages are like, hey, let's look behind the hood because there might be a reason for that that might not actually be sustainable, which we clearly lay out in that one pager. So you always got to go a bit deeper than you think when you're analyzing tokens, especially smaller ones. There's generally a lot of things that are untrue or that you might not realize. Okay, let's go to our last topic of the day, which we are going to discuss stablecoins because they are actually having a massive growth period at the current moment. So I've got DeFi Llama up looking at stablecoin market cap, which is just exploding over the last, 2 years. It's incredible to see, to be completely honest. It is really, really cool. Oh, where's the right? There we go. And we're currently sitting at $233.5 billion in stablecoins, up $4 billion in the last 7 days, which is pretty insane.
Crazy.
Up $1 billion in the last 24 hours and up 7.3 billion in the last 30 days. So these things, they are growing fast. The largest growth for the large ones are a combination of USDC continues to be a big gainer over the last year and a little bit. Tether is obviously still growing, but in terms of growth percentage, it's actually USDC. And then DAI or Sky continue to grow. And then what's this First Digital USD? They've got 20% growth, which is pretty massive.
Might be the new one from Binance.
No,
Yeah, I'm not sure. No,
I think this is like a
What?
centralized one that's been around for a while. I think.
is it? Yeah. Well, they're at 2.818 billion, so that's pretty big. And then Biddle, they're actually counting Biddle here as a stablecoin. 1.7 billion. They've doubled in the last 7 days or 14 days, and just today, this is Tuesday, they announced they're launching on Solana as well. So also really, really big news. My question is actually first, here's the predictions that I made this morning. By May 1st, and we are at March 25th, I think we hit 250 billion. So that's in a month and 5 days or 6 days. By July 1st, 300 billion. So first half of this year, 300 billion market cap. By Jan 1st, so the end of this year, 500 billion. And by Jan 1st, 2027, 1 trillion. And then my question, I'm going to have two questions. One is like, what does this mean for the crypto industry? If dollars on chain 4x in the next 2 years, that's a lot of capital, and it might even be more. I don't know. We'll see. So that's a big thing. But my other question, first question is, who the heck is buying all these, like putting all these dollars on chain? Is this the US government or other governments that are like, they want to hold the US dollars and this is the easiest way to do it and the cheapest way to do it? Is this corporations? Is this whales or people? Like, how are we getting billions and billions of dollars on chain? Does anyone have any insight into who's actually doing this? Because I get why, like we all understand the use case of stablecoins, but like who's really doing this right now?
And on which chain?
Well, most of this is happening on Ethereum at the moment is where most of the growth is, but yeah. But who's doing it? What do you guys think?
Okay, what are the options for who's doing it? Because I have no idea, and I have the exact same question of who's doing it. So, okay, could be governments, could be corporations, like institutional investors. I don't really see the reasoning for them to do it as much. Like I can see the corporate use case. The easiest,
Yeah.
It's probably the easiest use case for me to see is like you're a corporation, you're doing payments and remittances around the world. You see that you can do that much cheaper in on-chain dollars, and you have great infrastructure for your people to receive on-chain dollars, which I think was like a big holdup was a lot of your vendors and your staff and who you're paying were like, I don't really want crypto yet, but I think we've seen that grow a lot. So corpse is what makes the most sense to me, but I don't know.
I think corpse as well. Mainly, like for example, 30% of
Wait,
our
is
employees.
it corpse or crops, Kyle?
You saw I like, for me, it makes sense that corporations are doing this. Like we do it, right? And I mean, we're not a massive corporation by any means, but 30% of our employees are already paid in stablecoins, and a large part of our treasury is also in yield-bearing stablecoins in Sky. I don't see why others wouldn't be doing that, right? Like there's a lot of companies that have employees outside of the US as an American company or Canadian company. And it's like, it is so much cheaper and faster to do stablecoins. Like, why wouldn't you? And so I would imagine that's the large part of it. And I think the reason why we're seeing so much growth right now is the stablecoin bill is likely coming in the next like 60 days. Like, we might have it in April. And if that happens, like, corporations are definitely going to flood into this. The other one I could see is governments. Like, every government around the world and central bank, they hold dollars, and it's way easier and faster to do it through USDC than to do it in the other way. So I could see them starting to do it. Now that one's a little bit like iffy, like maybe not, but especially if they make partnerships or deals with USDC, which is how it tends to work, is like Coinbase, for example, has a partnership with Circle. Now they're also an owner, but they get a percent of the treasury yield, and exchanges do this a lot. Exchanges actually get, a percent of the yield. We don't, as retail, buying it on chain, but the larger corporations, they do. They swing deals with Circle and Agoric and some of these other ones that are out there. They actually can get a piece of the yield. And so I imagine if a government went to Circle, or a large corporation like Apple went to Circle, now I don't think Apple's doing this, but if they did, said, hey, we'll throw $1 billion or $5 billion or $10 billion, or we'll accumulate billions over the next year, but we want X amount of bips of the yield, Circle's going to say, yeah, absolutely, let's do that, right? That's kind of their biz dev model. That's what they do. It's how they've been able to grow as much as they have. Tether doesn't do this. I think they share next to none of it, but they're in a different world. But maybe they do behind the scenes. We don't actually know. But so I could see both corps and governments doing this and trying to get a share of the yield.
Are we talking about government institutions or central banks?
Yeah, it's a good question. Central banks, maybe. Like, obviously that's harder for them to do. Like, are they even allowed to? I don't know. It depends. Like, I would bet there's countries like El Salvador, right? Or like other countries that don't care about the rules, that are just like, I want dollars and I'm going to hold dollars however I can. And so they're going to do it, And so I do think there are some central banks that are probably accumulating this. I really do think that there are, because they need dollars. They want to hold them anyway. Why not get a little bit of yield on them and do it this way? Makes sense to me.
I think there are also two trends emerging here. If you would look deeper into that stablecoin growth, one of them is yield-bearing stablecoins have seen growth of 80% since Trump was elected, versus USDT and USDT just 30%. Obviously, they are already like much, much higher, but yield-bearing stablecoins are growing like almost 3 times faster right now. And the second trend here is Ethereum dominance was at 50% back in October. Now it's increasing again, and we are now at 58%. So it's also showing quite a trend here, that maybe like, if you would see the trend of the dominance of Ethereum for stablecoins, it kind of slowed down. But now, since Trump was elected, it's starting to grow again. So it's just telling me like, okay, we are all bullish on stablecoins, and where are all these new stablecoins minted? And most of them are minted on Ethereum. So it's telling me like, okay, institutions are coming. We don't know who are the users today, but probably most of that activity is going to happen on Ethereum, because that's where most of these stablecoins are minted. And then the second trend, again, yield-bearing stablecoins. So think of it like, if Bank of America, Revolut, PayPal, whoever creates their own stablecoin, that's awesome, great. But think of it as a onboarding tool for people to get into crypto and to the blockchain world. But then those people, those money will be looking for some yield. So I think it's very positive and bullish for Maker, Athena, these kind of guys, because they are going to offer what ultimately all the people will look for, and that's the yield for their stablecoins.
Yeah, and it starts with stables, then it turns to yield, right? And just put some context in the numbers you just said of yield bearing are growing faster. So Sky in the last month is up 20.7% in terms of new supply. So it's up $800 million in literally 30 days. And it's only what does it have total TVL? like a few billion. So like that's obviously a large amount. Athena is up.
Despite the yield reduction, when did that happen, Martin?
Yeah, despite the yield reduction. So
Okay,
yeah,
cool.
they're still growing. Athena up 1,222%. Now this is Athena USD TB, which I don't think is like a different one that they have, but either way, still one that you can get yield on. Then you have, what were some of the other ones I was looking at here? Ondos, which is a yield-bearing stablecoin, up 40%. There's one other one that I can't seem to find right now. But anyway, when you look and you see the big growth numbers, it's always in the stablecoins that have BlackRock up 200%. They obviously have yield as well. So any of the yield ones are growing much faster. But to see USDC in that, hey, here's a question for you guys. A lot of people are like, well, are talking about supply growth of stablecoins. The bear market people are saying we're in a bear market, but usually stablecoin supply continues to grow for like 6 months, 8 months afterwards. That's what happened last cycle, and that's what will happen this cycle. My take is we're going to grow stablecoins, bear or bull. Might even pick up during bear market, to be completely honest. So like, I think that take is absolute rubbish. My other question though is, if I look at this chart here of stablecoins, we were growing like crazy. We were growing for 6 to 8 months after the bear market, probably because people just wanted to get out of crypto and hold stablecoins. The only reason we stopped growing was because Terra Luna collapsed. And then we had a stablecoin bear market. But that was because people were afraid to hold stablecoins altogether, because one that was worth 40 billion went to zero. If Terra Luna never collapsed, like, I think we still would have had a bear market. Would stablecoins have actually gone down? I don't know. I think that would have just continued up, and we would have been way higher from here. You guys have a thought on that? This is just something I was thinking about the other day.
I think it would still go down, because then 2022, 2023, there were no yield in on the blockchains. So you would get much better yield using US treasuries or whatever. So like, I feel you always need to look for incentives, right? And like, back then, Stripe, Revolut, PayPal, they were not interested in using stablecoins yet. And it was still, on the roadmap. So I think we would still go down, because there wouldn't be yield, and all the people that show interest today about stablecoins were not showing that interest like 3 years ago. So I think we would still go down.
I don't know.
I think we would have gone down, but only slightly,
Like way less,
or flat, right? Like,
which is what we already kind of were here.
Yeah, you can see it in the chart, right? Like, that remove that wick straight down on like May 1st or whenever Terra Luna collapsed, and it still goes down, but not as much, not nearly, if you remove that wick.
Yeah. Well, lots of good times ahead. Good things are happening in this space. It's exciting. We get to talk about cool stuff, fun stuff, because there's actually cool shit being built on the blockchain right now, and I think that's exciting. Although I know a lot of crypto native people are very bearish right now, and a lot of retail is very bearish because they hold, I don't know, meme coins and a bunch of garbage. But like, when you look through all that, things are looking fantastic, and I couldn't be happier to be in this space right now. I don't know about you guys.
And to act anti-cyclic.
People always cry that, I don't know, VCs are, bad for the markets, whatever, that institutions are just using retail liquidity, whatever. But right now, retail is bearish on crypto, while institutions are bullish as fuck. And that's exactly the situations that, like, everyone, like, that's how the markets work all the time. Like, people are crying, and now, like, everything outside of Bitcoin is going down, and we should only hold Bitcoin, whatever. But institutions, they are coming, and they are going to use stable coins. They are going to tokenize everything. And that's happening on the public blockchains, on Ethereum or elsewhere. So like, we are just at the beginning of this huge next wave and institutions adoption. So just be bullish and just don't get your emotions get through you. And people are just looking at the prices and like, okay, nothing's working and blah, 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 whatever. Don't look at the prices. Just look at what's happening in the markets and where everything's kind of heading in the next, I don't know, years. It's super fantastic. And you couldn't be more bullish when you listen, I don't know, BlackRock, Stripe, PayPal, all these guys. Good times ahead.
Just listen to this episode every Saturday and nothing else. You can maybe listen to some of Jay's other episodes.
Maybe one day, Monday through Friday too. Just don't give up. Well, just don't give up. That's that's my main message right now, right?
Yeah.
Like if you give up now, you're giving up at possibly the worst time, right? Like it is. Everything is looking so good long term, but expectations have screwed everybody. Prices are down, and everybody expected something different. And when you have, I mean, it's true in anything in life, right? If I expect something from my wife and she doesn't deliver, it's very, very, I'm upset. I'm disappointed, right? But I don't expect anything anymore, and then I'm happy all the time.
That is wonderful life advice. Let's wrap it up on that. That's great.
Thanks for listening, folks. That's a wrap on another awesome episode. High fives all around. If you are sticking with me to the end, I appreciate you so, so much. I want to tell you guys about a question that I get asked a lot, which is, what are the ways that you can get gains from your crypto, especially your Bitcoin? If you've been holding Bitcoin for a long time, you got a big stack, and you want to sell it because you don't want to get taxed on it. Well, what do you do? One of the best things you can do is you can take a loan against your Bitcoin. And if you want to take a loan, I really recommend you guys check out Salt Lending. Salt's been a trusted name in the space. They've done over 500 million in loans, and their platform allows you to do loans quickly, permissionlessly. Usually get your loan within 24 to 48 hours, no credit checks. Hit the link in the show notes if you want to check it out. You guys won't be upset. Thanks again for listening, and folks, we'll see you guys back again Monday. Have a wicked awesome weekend. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.